Hey traders, this is Blake Morrow with Traders Summit, and with me I have Marc Chandler from Bannockburn Forex. He's the chief strategist there. How you doing, Marc? Good to see you.
Happy Monday.
Happy Monday. And you know what? A historic week for us to actually meet, and there's so much going on. The volatility has been, at a fever pitch. How are you navigating through the markets right now personally?
Yeah, very difficult. I'm just trying to hunker down. I think that for my own personal account, I haven't really done much in the sense that I had stocks that I believed in. And so I'm just going to have to weather this storm. I think there's not a lot of safe places to hide besides cash.
Well, okay, that cash, that's an interesting one. You didn't say gold. You said cash. So, but we could talk about that maybe in a few minutes. But there's a lot for us to talk about this week with the FOMC happening. The Fed's obviously going to be raising rates. At least I'm wanting to hear your opinions about that. But before we talk about the FOMC, maybe we should talk on a few other subjects. And one of them being, here we have COVID fears again in China. China's closing down some port cities. How do you feel about China's response to this COVID situation, where you look in the United States and I know I live in the Wild West. I live in Arizona, which is probably a little bit different from where you live in the Northeast, but people are pretty much over it here in the United States. So what are your thoughts on China's response to the COVID situation right now?
Yeah, I think that, we're so here in the US and maybe in Europe as well, we're so centric. Like the world revolves around the US and Europe and high income countries. And the problem is that, there's many developing countries that have had very few vaccines, if any. And China and Hong Kong, but also Asia largely, is still being plagued by the virus. It's not just China. Hong Kong has serious cases. And, Japan declared the quasi-emergency, and they're still in that till later this month. And so, yeah, I think that for me, China, zero tolerance, producing these lockdowns. And like you say, we saw the lockdown in Shenzhen, and more restrictions in Shanghai. And so I don't know what to tell the Chinese. I'm just thinking about what it means for us. And I think that the thing that we as investors, as business people, we should be thinking about is the knock-on effect is going to be disrupting supply chains and probably boosting inflation. So we have this double whammy that's not good for us. And so, but I think this is really the lesson from COVID. And I see it even here in the US, where poverty itself is a comorbidity. And so my family cannot be safe if that homeless man on the street has COVID. And so we have to think of it as much more comprehensively than just this tribalism that often characterizes these kind of things, whether it's the pandemic and looking out for the US or looking out for our own neighborhoods. It's a problem that's really social, and it's bigger than us. And I think that the disruption in China, Hong Kong, Japan has serious knock-on effects on us that aren't good.
Yeah, and you might have the rest of the world, meaning us, looking at that part of the world, saying, "Wow, why are you guys so worried about COVID?" But it has probably more to do with as you and I were speaking about earlier. Maybe some of the vaccines and effectiveness that they have there, right?
Yeah. So the quality of the vaccines, and also, so like myself, I mean, I've had I've been vaccinated twice. I had the booster, and then I caught it, and though without symptoms, which was thankfully. But at the same time, I think that there's natural immunities that, because China has squashed it, prevents these natural immunities also from rising. And so China's a mess. And we see this. I mean, the economy is slowing, and I see some forecasts talking about stagnation here in Q1. And so that's going to mean China's going to have to stimulate more rate cuts, perhaps as early as tomorrow. It means more fiscal stimulus for China. And so, yeah, so Chinese economy is weak. And I think that I'm looking at this, what they call the golden dragon, the Chinese stocks that trade in the US. And these stocks, the index of them, I think it's called the NASDAQ Golden Dragon. And I'm looking at it the last 2 weeks, it's down over 25%.
Wow.
4 weeks down in a row for nearly closer to 30% over these past 4 weeks. So Chinese stocks are being hit by COVID. They're being hit by their own technology squeeze, the property development sector. China's in serious problem. And I would say that, not to get too far ahead of our story, but I'd say that China is probably one of the biggest losers from Russia going into Ukraine. More than people talk about it winning and coming out ahead and all this, and I see China as being a big loser in all this.
Well, I'm glad you brought that up, Mark, and you kind of teed it up. Now, how do we look at the Russia-Ukraine situation? I mean, it's just really exacerbating like all these commodity pressures that we're feeling here in the US almost across the board. How do you feel this is going to impact? Well, let me take a step back really quick. How are you looking at the Russia-Ukraine situation, the invasion of Ukraine? How's it affecting? Now, you were mentioning about China, but how's that going to affect other parts of the world like us in the United States? So what are your thoughts there?
Yeah, so a couple of things I'd say is that we might think that the higher commodity prices is inflationary, and maybe at the first cut, it's inflationary. We'll see. But we saw this already with the last week's CPI. Tomorrow we get the PPI, and so we have a higher. It's going to feed through to higher inflation, but it's ultimately going to be a brake on the economies. One of the big things I've been talking about even before Russia invaded Ukraine was that the last 3 business downturns in the U.S. were preceded by a doubling of the price of oil. So this talk about stagflation, I think, is a bit early in the game, in the sense that, we're going to have more inflation, but stagnation if we're lucky. I think the more likely case is that we're in a recession, and that's going to drag down prices because it's going to compress demand. Yeah. People see higher oil prices, so they think, oh wow, it's like going to be inflationary, but because there's not enough supply. But at the same time, it's going to reduce the demand, and this is what's going to this compression of demand is what's going to drive us into recession.
Okay, and then just to, I guess, as just stopping here at this subject, you think that high prices are going to basically tame high prices, but won't pressures stay elevated in a lot of commodities because of what's happening in Ukraine right now?
Yeah, so there are things that are going to stay high for a while. I mean, it's going to take a while to make up for, say, the Russia and Ukraine wheat, sunflower oil. We saw what's happening in nickel. What an incredible catastrophe. I mean, we're unwinding trades from a week ago. And so, so the echo is going to be here for a while. But when are we really talking about recession? Not until later this year. But I think you're right. It's going to take a while to get the supply, even like oil. So say Russia exports something like, say, 5 million barrels a day. Where are we going to get that supply from? Our own shale producers are in the U.S., we're producing less oil than we were before the pandemic. So it's coming at a rough time. Inventory levels are low. And so, I think that commodity prices stay high, and we still go into the recession. But again, what's going to happen is that over time, maybe it's going to take a season or two. We'll get the crops coming back. Other places are going to plant. Brazil and South America has had a horrible weather that's hurting their crops, like soy. And so, so I agree with you that the supply chain is going to take the supply of agriculture and these commodities are going to take a while to build back up. And I'm concerned about what it means for this shift into electric cars and electricity, electric-driven vehicles. I'm concerned about what this means. I think, to me, it's a big distraction. It's like a couple of boys playing in a sandbox. And what I mean by that is Central Europe has been like you just think about without being like history majors in college or things, we all are familiar that Central Europe is sort of like those center 4 squares in a chessboard. You don't have to own them. You don't have to possess them. But who controls them ends up having a lot of control over the chessboard. And same thing in Europe. For centuries, our species has been fighting over the same piece of real estate in Central Europe. And I think that distracts us from the real issues, public health. I mean, who knows what the next virus around the corner, the climate change. It's not going to help us with climate change very much. So I worry that this is a big distraction, needless distraction.
Interesting. All right. Well, let's turn our attention then, Mark, over to the Fed this week. I mean, how's the Fed supposed to handle this? All of these, I think many of us over the last year had thought, the Fed really needs to raise rates and get on it. We saw the inflationary pressures coming, but also to combat, all of these, risks that are now popping up even before the Fed's been able to lift off. So how do you feel the Fed's going to react this week, and what's the message that they're going to bring to the markets on Wednesday?
Sure. So I think that the Fed's decision, I'd break into three parts. One is the rate hike itself. I think that's a foregone conclusion. I never was in the camp that thought that the Fed leadership was really behind Bullard, the St. Louis Fed president, talking about 50 basis point hike. And maybe there's a governor, his actually kind of interesting, the St. Louis Fed president, Bullard, among the most hawkish, his head of research became a governor on the board, Waller. And Waller is among the hawks as well. But I'd say that the Fed's leadership, and by that I mean Chairman Powell, but also like the New York Fed, who gets a permanent vote on the FOMC, Williams, I don't think they were ever really behind that 50 basis point call. But in any event, as we sit here, a couple of days before the event, it's quite clear that the Fed's leadership has come out very strongly in favor of that 25 basis point rate hike. Second component, of course, we're focusing on as well, is the balance sheet. Yeah. So the Fed's expanded its balance sheet. At his testimony earlier this month, Powell suggested that there'll be some indication about the pace that they'll let the balance sheet unwind. And the way they let the balance sheet unwind is simply letting issues that are maturing, not recycling the full amount back into new treasury purchases. So many of us think the Fed's balance sheet will begin shrinking towards the middle of the year. Maybe it's June or July. And the third component is the famous dot plots. Those are like the Fed's forecasts. And of course, we're going to see the Fed, even Powell suggested in his testimony about a month after the December dot plots, that if he could do his dot again, it would be higher. So it seems to be a pretty clear indication that the Fed recognizes things that, like you've been saying, about inflation being higher than we expected, lasting longer than we expected. And so the Fed's going to recognize that by boosting the number of hikes this year, but also possibly, and this is, I think, the key, is not just how much the Fed raises rates right now, but it's also what's the terminal rate? Where will it peak? And I think that we're going to see, can it peak above neutral? And neutral for the Fed is about 2.5%, 250 basis points. Could the Fed in this cycle, given all these other headwinds, can they raise the rates above the neutral to really be tightening as opposed to just removing accommodation? And so far, I'd say the market is sort of agnostic about it. The market sort of sees the Fed getting close to neutral. And, it depends on which high frequency data comes out that day or that moment where the market is on it. But I think that's going to be the important thing, is how close to neutral or above neutral will the Fed signal. I don't think the Fed has that much of a choice here. I mean, I think they've got to raise interest rates, and I don't think they can begin unwinding its balance sheet immediately, as much as some of us wish it would. I think that there's a debate right now whether the Fed should, one of the things that's been happening is the yield curve has been flattening. And by the yield curve, so one way to look at it is the 2 to the 10-year yields. Yeah. And that curve is really flattening below 25 basis points. Many people think if it goes inverted, it's signaling a recession. So what could the Fed do to avoid that? And there's been, I'd say, a vocal minority pressing for the Fed to rely more on its balance sheet unwinding than on the Fed funds. Yet Powell tells us that the Fed funds will be its primary instrument for implementing monetary policy, and that it thinks that the Fed thinks that it could unwind, it can have the balance sheet unwind sort of quietly in the background. I think that this is yet to be proven. What the Fed really hopes, what we all hope, is that the Fed can engineer a soft landing, and by that, reduce inflation, compress demand without driving us into recession. And as much as I wish them good luck with that, if it was a horse, I would not want to bet on it.
I was going to say, Mark, it's been a long time since I've heard the term soft landing. It's been a while. I mean, I want to say it's been years. So I'm glad you brought that back into style, if you will. But how much do you like? Are you happy you're not part of the Federal Reserve at this moment?
Well, I think that the Fed could always use this is the problem. I think it might be very politically incorrect to say this because they're so focused on this diversity of the Fed, having more people of color, more women. And that's all good. I'm very progressive in that regard. But what concerns me really is the intellectual diversity. If all the people went to the same schools, read the same textbooks, is there really that much diversity despite the colors of skin or religion race that people might have. And I think that I don't want people who believe the Earth is flat to be on there. I don't believe in that much diversity. But at the same time, I think that when I try to create a team, and perhaps you do the same thing, what we really want is a diversity of people, of ways of people to solve problems. Because we're always encountering problems that we haven't seen before, where history is not always the best guide. And so we need is people on our team, people we can work with that have a different way of solving problems. And I think that the Fed has, I don't think the Fed's achieved that. I think that the Fed is still in a position so that where all they have is a hammer and every problem looks like a nail.
Well, okay. Well, we're going to leave it at that. But I want to ask you this, Mark. If you're trading the markets, how do you think? Just quick responses here. How do you think the dollar is going to respond? How this week? How about gold? Do you have any technical outlooks? One of the things I love about you the most is that not only you look at the bigger picture, what's happening on more of a macro level, but you also look at the technicals in the market. So anything jumping out at you for us traders to think about?
Yeah, two big things I'd say. One is that the interest rate differential between the US and other countries is widening. And that, I think, underpins the dollar, at least in initial stages. Yeah. And I think we're still in those initial stages. And by that, a couple of months ago, Australia and Canada were offering a premium over the US. Now they're at a discount. I think about what's driving, dollar yen today is getting above 118. We haven't seen these levels since, I think, 2015. Yeah. And what's driving this? It used to be recently we'd say, well, safe haven, stocks sell off, people are unwinding positions, they move into the yen, or they reduce the yen short positions. And yet right now I'd say that, and that's the second point, besides the interest rate differential is widening, is the drivers are shifting. The yen now seems to be more responsive to the US 10-year yield than it is to falling stocks. And we can see this in other currencies too, including the Canadian dollar, which it doesn't seem like the jump in oil prices helped it very much. I'd say that the Bank of Canada, we've had that monster jobs data at the end of last week, and still Canada can't really sustain a rally. And I think the problem there is that what could be indifferent? Should you hold your margin money in Canadian T-bills or US T-bills? And the market's telling you we'll pay you more to hold it in US T-bills. And so those are the two big things that I think have changed. Is one is the interest rate differential becoming more important, widening out, broader number of countries, and the shift from risk on, risk off for the yen and the Canadian dollar to really focusing again on those interest rates.
Yeah, I was going to say, and commodity currencies in general. And really, really quick, Mark, do you have any view on gold? Are you one of those gold bugs that feels that gold's going to surge to new highs, or do you think it's going to come off a little bit here?
I think we might have seen an important high last week in gold around 2070. Of course, things are very fluid. What happens in Russia? Sure. What happens? Over the weekend, Russia's trying to get close to those to the eastern part of Ukraine, so the western part for Poland, and the war could widen. I mean, of course, the odds are above zero, even if it's not the most likely scenario. So it concerns me if the war does widen, gold can get another leg up. But I think that we're going to see maybe 1950, maybe even 1900 in gold. I think that the higher interest rate environment sort of saps the demand for gold. Sure, there's some idea that Russia or people are being sanctioned, move into gold. I just don't see the gold market big enough to really withstand that. I don't really know if it's sort of like there's this anthropologist that try to say, how do we distinguish between somebody who's got a twitch in their eye and someone who's winking, and then someone who's mimicking one of those people? And I think that's really where we are, where people are trying to anticipate what Russians are going to do with gold and crypto. And we try to position it anticipating that they're going to be coming in after us. And I think that we've been left holding the bag.
Interesting. All right. Well, Mark, I love your work. I love reading your stuff every day. I try to do it every single morning. But how do people find out more about what you do? Because I love reading your column. I think everybody needs to know about it.
Sure. Well, I appreciate you posting my comments up on your websites. Yes. I have my blog called Mark to Market, and it's this kind of strange thing that comes from that first book called Making Sense of the Dollar. And the Mark to Market was just I was doing that at the time, and I think it goes back to like 2006, 2008, when I began posting stuff on the blog. I'm on Twitter. That Mark Making Sense comes from that book title as well. I have an open DM. I'm always looking for people to collaborate with and to discuss the markets with. So feel free to reach out to me and check out that blog.
All right, Mark, thank you so much for contributing to the Traders Summit community. We love reading your things. And if I say things, his posts, Mark, and you can actually get to his post just down below if you're watching this on the Traders Summit site. And if you're watching us on YouTube, make sure you give Mark a thumbs up for giving you his thoughts ahead of the FOMC, and subscribe to our channel so you don't miss any of our great content that we have here. Mark, I want to thank you so much and good luck this week for the FOMC.
Thank you. Good luck to everybody.
All right. Talk to you soon. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.